What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we're looking at what the Texas blizzard blackouts have to teach us about investing. I'm sure by now everybody in the world has heard about everything going on in Texas right now and how there's rolling blackouts that aren't really rolling. You know, everybody's kind of stuck in no power, no utilities, freezing weather, groceries everywhere sold out, restaurants all shut down, freeways shut down, so you can't, leave to go somewhere. So just an absolute horrible thing going on right now in Texas. So wishing the best for everybody. If any of you are currently in Texas, I'm wishing the best for you guys. And luckily, Texas, at least this is kind of probably maybe a little bit more of a stereotype, but hopefully everybody there kind of fits the stereotype of being preppers, and maybe that'll help more people get through this with as little suffering as possible. But at least for now, it's probably even close to like a life and death situation for some people. So wishing the best. Hope you guys get through it as fast as possible for anybody who's in Texas. But that being said, this whole situation actually has some good lessons built into it on for investing and risk management and hedging. And so we're going to talk about that today. Ready? Let's dive in. All right, so the biggest thing that this whole thing going on in Texas teaches us right now is that tail risks are not predictable in advance. Anytime you look at a previous disaster, anytime something that happens that is just bigger than anything that happened before, that goes down in history as kind of the benchmark. And so you have you when you're building a dam, like in China, I can't remember the exact name of it, but they recently a big giant dam just failed in China, and the reason for this was because they looked at the previous largest flood that had happened in that region and built the dam in order to sustain that flood. But the reason that previous flood was the biggest one that had happened in history is because it was bigger than everything that had happened before it. And so you can't predict the size, the extent, or the type of disaster that happens when you're dealing with tail risks. And I don't know if anybody, maybe there were some out there, I don't know if anybody was truly prepared for basically a blizzard in Texas. Even most preppers were prepared for, the heat side of things, heat waves, not for, everything freezing over. And so that it just goes to show that you, for things that are, when you're preparing or hedging, you have to prepare for worst case possible, not for the likelihood of something happening, because nobody would have thought that a blizzard is possible in most places, at least in Texas. Now, the nice thing is that with investing, it's actually a little bit easier because you don't have to really prepare for and be creative for things that are kind of seem outside of the realm of possibilities. Worst case scenario with investing is basically just it goes to zero. There's not like another, unless you're like margin investing, then if you're trading on margin, day trading, or holding large balances, then it goes to zero. Then your worst case scenario is you actually owe money. But ultimately, the worst case scenario for any specific investment is that it goes to zero. So it's actually a little bit easier to prepare and hedge when you're investing versus something like, prepping for blizzards in the Sahara Desert or something like that. And so we've got a couple different ways that we can hedge and deal with tail risk, and in order of like least effective to most effective. So the first way to deal with risk is going to be diversification. You've heard me say it many times before. Diversification is not what people typically mean. It's not what people typically say when they are talking about diversification. They say don't put all your eggs in one basket. But if you, let's say you own 500 stocks, and they are all the 500 stocks that are in the S&P 500. The S&P 500 right now, the stocks inside of it are almost perfectly correlated. Not 100%, but close enough. And so what that means is that you don't actually have 500 positions. You have one position, and they're all the same position. You have the S&P 500 because when the S&P 500 goes up, all the stocks in the S&P 500 go up, and they all go down together because of index investing and the nature of the markets right now. And so if you have highly correlated assets, every one of your assets that are highly correlated, they're just put together. It's just one asset, so you're not actually diversified. So the key to being diversified is to have uncorrelated assets, and you can get a very well diversified portfolio with 8 to 12 uncorrelated assets. You don't need hundreds. And in fact, if you get up to that number, the likelihood that you're incorporating assets that have a high degree of correlation with other assets in your portfolio starts growing and increases very quickly. So uncorrelated assets is the key. Now, in the past, something like 60-40 was uncorrelated, right? If stocks go down, bonds go up because, money is leaving stocks and going into bonds, and vice versa. In growth environments, money that leaves bonds goes into stocks. That's done. The correlation between stocks and bonds is very high. Even today, in fact, over the last week or so, stocks and bonds have been falling together, and over the last couple of decades, in general, stocks and bonds have been going up together. And so the correlation between stocks and bonds has been getting tighter and tighter. And so like 60-40 from a diversification standpoint doesn't really do anything, doesn't do much for you, because in tail events or in crashes, the likelihood is they both go down together until something like the Federal Reserve steps in and starts buying more bonds and then purchasing equities, which I think they'll probably start doing at some point this year. So preparing for the worst case scenario means imagining that your investment goes to zero, because that's worst case scenario. Maybe not likely, but we're not talking about preparing for the likelihood of something happening. We're talking about preparing for the worst case scenario. And so having uncorrelated assets means that if your worst case scenario happens in one thing, that your worst case scenario won't happen across your portfolio because they're uncorrelated. Now, that's per investment. So from a broad perspective, you're also going to need to think about what's the worst case scenario for my portfolio overall, because what if my assets that have been historically uncorrelated become correlated and they all go to zero, let's say at the same time? And so that's when you have to start thinking about doing things that, maybe you think if this goes down, this is going to go up, but what if they start going down together? And so you can do something. The second way is doing something like stop orders or stop limit orders or trailing stop orders, some of these a little bit more advanced orders rather than just, buying and holding. And that way, let's say you put in a trailing stop order at 10%. So you buy something, if it goes down 10%, it automatically will sell it for you. So on that specific investment, your worst case scenario is going to be a 10% loss. And if it's a trailing stop, it goes up an unlimited amount, and then at any point, the furthest it can fall is 10% before it triggers a sell order. Now, stops are better than nothing, right? Because at least you have a mechanism that's set up to pull yourself out if everything's going down. They are free, but they're not guaranteed, right? Because if something overnight gaps down and it opens up 50% lower than it was at yesterday, well, it's 10% or more. 50% is over 10%. So it'll trigger a sell order for you. You'll get out at a 50% loss instead of a 10% loss. And so it's not guaranteed, but like I said, it's better than just buy and hold and hope and wait. And, then it, goes down 50% and now you have to wait 10, 15 years for it to come back. The third way to do this is with options. Now it's a little more advanced and they do cost money, right? So other than like stop orders are free, puts actually cost money, but they also do give you a guarantee that, you're purchasing the right to sell something at a specific price. And so you can do some creative things with this as well. I know there are lots of, things you can invest in this world that don't actually have stop or puts. You can't actually buy puts on a lot of things that you have the ability to invest in. So for instance, let's say you've got, a portfolio of, a couple dozen rental properties, and you want to protect yourself against a severe decline or crash in the real estate market, then you can purchase puts on a REIT or a real estate ETF, right? Because or even just like a stock that is a publicly traded company that holds a lot of single family homes or certain types of real estate. And a lot of these ETFs and REITs and stocks do have puts on them. So might not be a perfect protection, but at least that put would gain in value then. In proportion to or at the same time as your real estate portfolio, your physical real estate portfolio is declining in value. So you don't just have to do it on like individual stocks that you own. You can be a little bit creative with these. Same thing with like gold. Let's say you've got, gold in storage or in your home and you want to protect it. You can buy puts on GLD, the ETF. And so if gold starts to crash, then you have a put that's increasing in value while your physical gold is decreasing in value. And so you can be a little bit creative with these. Now, let's say you have a basket of stocks and they're, let's say, small companies or obscure companies and they don't have options traded on them. Still no big deal. You can look at your overall portfolio. You can say, hey, look, I've got, let's say a beta of 1.5, which if you don't know what beta is, it's just the volatility of your portfolio based on or in compared to your benchmark. So let's say you're comparing it to the Russell 2000. That's your benchmark. If the Russell 2000 loses 10% and your portfolio at the exact same time loses 10%, then your beta is going to be 1 because you've got the same volatility as the index you're comparing yourself against. But let's say it loses 10%, you lose 15%, or let's say it gains, 5%, you gain 10%. Your beta will be higher. It'll be, 1.2 or 1.5 or 2. That just means your portfolio is more volatile than the index. And so then if you want to protect your portfolio, you just buy puts on the index. And so if you're exactly correlated with that index, then you just buy enough puts to protect yourself as if your money was invested in that index. If it's more volatile, then you need, let's say it's twice as volatile, you need twice the protection. So you just buy twice the number of puts. And so you can be creative with this. Now, if you're looking to get into options and you have never touched an option before and don't even know what a put is, I have a beginner's foundations course on options linked in the description below. And then if you already basically know the basics of trading, the fundamental, the standard option strategies, but you want to level up, I've got an advanced options course that teaches all the advanced like 3-leg, 4-leg strategies like diagonal spreads and iron condors and things like that. And so either way, whether you're a beginner or you want to level up and become an advanced options trader, I've got both of those courses linked in my description below. So check those out. So again, if you're in Texas, I wish you the best. And for the rest of us, let's just take a lesson and realize that you have to hedge for the worst case scenario because the likelihood of something happening is unknowable. As always, thanks so much for watching. Have a good day.